Mastercard stock has delivered an incredible 556% return over the last decade, with profit margins nearly 7 times higher than industry averages. The company seems unstoppable. Yet, strangely, the smartest investors on Wall Street are hesitating to buy more shares. So, is there something about Mastercard that super investors understand but most of us don't? Or is it just too expensive? Today we are going to go through our 7-step analysis process to find out what makes Mastercard such a financial powerhouse. We'll explore whether this company is worth its premium price and if it deserves a place in your portfolio alongside its rival Visa. Mastercard is one of the world's largest payment processors. It doesn't extend credit or issue cards directly. Instead, it makes money through transaction fees every time someone uses a Mastercard branded product. The company is also positioning itself for the future of finance, recently announcing that 2025 will be a turning point for crypto and banking due to more transparent guidelines and increased blockchain adoption. But let's look beyond the news headlines and see what the numbers tell us. If you invested $1,000 in this company 10 years ago, you bought 11 shares, and today they would be worth something close to $6,407. And this company also pays dividends, so in that time you would get $171 as dividends. So if we add together the current value of shares and the dividends, we get $6,558. And that is a gain of 556% in 10 years. That is an impressive return. Let's see who benefited from this exceptional growth. Individual insiders, that is an X, only 0.1% of the company is owned by individual insiders, and we would like to see this number over 2%, so unfortunately the management doesn't really have much skin in the game. And are individual insiders buying? That is another X. We don't see any significant insider buying recently. And do super investors own this company? That is a check with 16 super investors, including some of the best minds in the business like Chuck Akre, Guy Spear, and Thomas Russo. And are they buying right now? That is an X. Only Francois Rochon bought shares last quarter. Meanwhile, 9 other investors actually reduced their positions. So let's try to understand why so many great investors own shares of Mastercard but aren't buying more at the current price. Return on invested capital, that is a massive check at 45.2% 10-year median returns. And we want to see this number higher than 10%. So that is an absolutely incredible result, one of the highest we ever saw on this channel. And what do we know about net profit margin? It is a check averaging 44.6% over 5 years. The industry median is just 6.8%, and Mastercard has the 3rd highest margin in the industry. With such incredible margins, it's clear that Mastercard has significant pricing power and an extremely efficient business model. And now let's take a look at share buyback. It is a check. They bought back 21.5% of their shares in the last 10 years, meaning long-term investors now own a bigger portion of the company without investing any additional capital. And the debt, it is a check. It would take just over a year to pay off all long-term debt with a current free cash flow. And we want to see it under 2 years, so Mastercard is in excellent shape. Well, it's checks all around. I think it's pretty obvious that this is a financially robust company. But financial health is only part of the story. We also want our companies to grow. Revenue growth, that is a check at 11.6% 10-year compound annual growth rate. And we would like to see this number higher than 10%, so they just made it over our threshold. Free cash flow growth, that is a check at 15.4% over the last 10 years, so that's even better. And earnings per share growth, that is another check at 16.2% over the last 10 years. Well, earnings per share are higher than other metrics, partly because of those share repurchases we mentioned. If there are fewer shares, each one represents a bigger portion of the earnings. So overall, Mastercard is delivering healthy, consistent growth. But there is another way to create value for shareholders besides growth and buybacks. Dividend yield is 0.5%, so shareholders can expect to get $3.04 annually per every share. That is not a high yield compared to many dividend-focused investments. And the payout ratio, that is an X at 18.8%. We want to see the payout ratio somewhere between 20 and 50%. Mastercard is just below our preferred range, meaning they are paying out a smaller portion of earnings that we typically like to see. However, that also means the dividend is very secure. And what about dividend growth? It is a check at 14.5% 5-year growth rate. Very impressive. And actually, with such growth, the dividend could double every 5 years. So, although the current yield is low, the growth rate is excellent. But at the end of the day, every business has its price. Let's value Mastercard to see if it's worth buying at the current levels. The price-to-earnings ratio is 34, which is significantly higher than the S&P 500 average of 27.3. So Mastercard is definitely trading at the premium compared to the broader market. But to properly calculate the intrinsic value of this company, we will use a discounted cash flow analysis. And if you would like to learn how to value companies on your own using the 4 most popular models, visit stockinvesting.academy and explore our company valuation course. Okay, so first we have to estimate the growth of Mastercard for the next 10 years. In the low scenario, we will estimate a growth of 11% for the first 5 years and then 10%. In the medium scenario, 13% and then 12%. And in the high scenario, 15% and then 13% growth. So the low scenario is equal to the predicted growth of the industry, which is around 11%. The medium scenario shows a story in which Mastercard continues to grow at a similar pace to what we've seen in the last decade. Well, maybe a bit slower. And the high one is predicting that they will very slightly accelerate their growth, potentially due to new opportunities in areas like crypto and blockchain that Mastercard is exploring. So, with such estimates, the intrinsic value in the low scenario is $341, in the medium scenario $396, and in the high scenario $444. And we have to always apply a margin of safety to those prices. I use a 30% one, and with such a margin, we get in the low scenario $238, in the medium $277, and in the high one $311. And the current price is around $540. So it is all in the red. Mastercard appears to be significantly overvalued at the current price, even in our most optimistic scenario. But before we make any investment decisions, let's try to put everything we've learned into perspective. So Mastercard is a phenomenal company with exceptional financial health. If we open our Stock Ranking Pro and sort all the companies we ever analyze on this channel by the overall score, we see that it is the 7th best company. And when it comes to financial health, it is 2nd. That shows some real strength. And looking at our overview diagram, we can see that it is extremely well-rounded, especially when it comes to financial health. Also, let's take a look at the history of Mastercard. The revenue, free cash flow, earnings per share, and dividends all show consistent upward trends over the past decade, which is exactly what we want to see in a high-quality business. And we shouldn't expect any massive changes soon because Mastercard has a lot of tailwinds. Digital payments continue to replace cash globally, creating a massive growth runway. The company is also preparing for the future with its focus on crypto, blockchain, AI for fraud protection, and digital wallet integration. However, we can't ignore the price. Even the highest valuation scenario with no margin of safety puts the intrinsic value at $444, which is still significantly below the current market price. So the big question is, does Mastercard deserve this premium? And the answer might depend on your investment style and time horizon. For long-term investors who concentrate on quality over price, Mastercard's predictable growth, exceptional margins, and industry dominance might justify paying up for it. After all, truly exceptional businesses rarely trade at bargain prices. On the other hand, if you are a value investor who strictly sticks to margin of safety principles, you might want to put Mastercard on your watch list and wait for some kind of price dip before considering a purchase. Thanks for watching and see you in the next one.